Well, Larry Goldberg, it's my favorite time of month, not just because I get to see you, but also because we get to talk about Cathie Wood's monthly report. So this particular time, I wanted to take it just a little differently. I wanted to add on to the end of the Cathie Wood review with a little bit of our own talk about the economy, because you and I picked up on something 4, 5, 6 weeks ago that the Wall Street Journal finally figured out yesterday.
Right.
I want to talk about that for a minute. And I think that'll be a lot of fun. And then Cathie spent a lot of time talking about the Tesla story, in particular, what's going to happen on Thursday. So I'd like to start there. I don't want to go really deep, but over the last couple of days, there's been an awful lot of stuff going on with lawsuits and with regard to people making decisions about yes or no on the Tesla comp package. I mean, the Elon Musk compensation package and the move to Texas. I've talked plenty about it yesterday on the show, so I'd like to just give you the floor and let you talk about where you see things as we get into the final 5 days before Thursday.
Well, I've gone on record to say that I think the vote is going to pass. I think it'll pass at a lower margin of majority than it did in the 2018 vote. In 2018, it was over 70%, 71, I think. I think it will be under the 70% mark. It may even be under the 65% mark, certainly be above the 60% mark. That's my belief from the kind of polling I've been doing and the numbers I'm doing. I think we have a huge vote of thanks to Tesla Boomer Mama for improving and dramatically improving, not just improving, but dramatically improving the retail shareholders' participation in the vote. I've spoken to some people here in Europe who have been able to vote as a result of Tesla Boomer Mama's intervention. That's not true of several German folks that I've spoken to, because the German banks have been absolutely unrelenting in their, just their refusal to actually do anything. But nonetheless, certainly the French, the Dutch, the Danish, and the Norwegian people I've spoken to, very strong support from their banks as a result of the work that Tesla Boomer Mama has done. Yeah. So, Alexandra, fantastic job, just fantastic job. And then, I saw today with great disappointment the head of the Norwegian, National Fund saying that they were going to vote against it, or the Norwegian National Fund saying they were going to vote against it, despite, his reach out to Elon Musk, which is, terribly duplicitous. And I hope Elon does not attend the lunch with him. It is a slap in the face, just a slap in the face. They own 1% of the company. I mean, they have ridden on, Elon's coattails, and
so much money.
it's just terrible. But okay, nevertheless, I think it's going to pass, and I think it should pass. I think we owe Elon this money. Not only do we owe Elon this money, we owe Elon a huge debt of gratitude. But the point that I will make, and the point I made very strongly, in criticizing somebody who was opposed to Elon this week in a post on X, the point I want to make is we are not done in the innovation phase at Tesla. We're not done.
Right.
People say, oh, he's taken us this far. Now it's time for a normal CEO. What a normal CEO will do will stop FSD, stop Optimus, will stop all the revolutionary things that this next wave of growth is, depending upon. And so we absolutely do depend upon Elon to be there to take us through this next phase of growth. And it doesn't need his full time and attention. It needs his drive. It needs his focus. It needs him to put the focus into the folks that need to do it. I mean, you only have to read Walter Isaacson's book as to how he drove that team, the SpaceX team, to adopt stainless steel for the
Starship.
Starship, and for the trade-off in weight and in complexity, and to perfect the ability of that vehicle to actually come back from space at the kind of speeds and with the difficulty to do to be reusable. It's not a done deal yet, but man, they've gone, they've made huge strides, gigantic strides, and he drove that. So yeah, we need Elon. We need Elon very badly. And if this thing doesn't pass, I don't see how we keep Elon on board and focused. I just don't see it anyway. So only a couple of days left. People need to go and vote, whether you have 1 share, 1,000 shares, 100,000 shares, or 1,000,000 shares. Go and vote.
All right. So that, of course, was Cathie's message as well. She was really putting forward the idea that we need Elon, that Elon has accomplished, that he is the driving force. I mean, I just don't think anybody that watches this channel has a question about that, but there could be a few. So I wanted to bring all that up. She also ended her video yesterday by talking about innovation and talking about AI. And I also noted, I don't know if you watched yesterday's version of the All In podcast, but Chamath has continued to make this point that there have now been hundreds of billions of dollars invested in AI in terms of buying chips from NVIDIA, et cetera, but only about $10 billion of actual value coming out the other end in terms of consumers and end users getting something they could point to profits or point to usability, et cetera. And he says it's not, this AI revolution can't be all about improving your experience talking to a chat box on a web page.
It's becoming a generally, it's becoming a general understanding of the reality.
Yes.
And so we're in this, this kind of realization of reality space. But at the same time, Tesla is really that close on FSD, really that close. I mean, we're within a year away from true FSD and true autonomous FSD. And so this is the breakthrough moment where Tesla actually shows people what real AI can do.
Right.
So it's very, very, very important that we stick to it at this point.
And then on top of that, of course, Optimus. So, that was the point. I think
that's yet to be proven. I mean, I think we've got longer way to go with Optimus than we have with FSD, personally.
Yeah, we can agree to lovingly disagree, but no, that's not to say that I think FSD could be cured by 8.8. It might happen. We might have the full 100% by 8.8, or maybe it's at 8.9, or maybe it's at 9.9. It doesn't really matter. If it's
maybe 8.8 of 2025, but it's close.
In any case, and same thing with bot, though. I think the bot is this close to being usable, useful, and shippable. Again, it could be next year. It could be 2026. I wouldn't complain. In either case, we all do very well as an economy, as a world. as investors. So anyway, but that was kind of the point of both Chamath and of Cathie, is that
Right.
all of this AI is pretty useless if it doesn't turn into usable products that provide a valuable result for consumers and end users in business-to-business environments.
Right.
Yeah. So and that Tesla is by far in the best position of any company out there to actually have those use cases. So anyway, I thought those two were extremely useful. Let's go ahead and boot up the, as always, Randy will have trouble finding his way. All right. So Larry, I know that your favorite thing every month is about the M2 and M1 and all that kind of stuff. And Cathie went into a lot more detail about it this time. So let's start with her first chart, which is the M2 money supply versus CPI inflation. Talk to me.
Well, firstly, you must understand in this chart that the money supply has been moved forward by 18 months. So, the dark blue line that shows money supply collapsing and now rising again. We're showing, it forward. So the line that shows 2025, the date that shows 2025, is showing you where we think CPI inflation will get in that 2025 timeframe, and the green line is where it is is the CPI inflation where it is right now. So 2024. So what you see is that the money supply collapsed due to the Federal Reserve clamping down, and it collapsed, and as a result, prices have fallen, but it is now beginning to rise back to zero again. And so we think that we will see a continuing drop in inflation rate and until it starts recovering. But that's only half the story. And, I've said this again and again and again in every one of our talks. It's only half the story, because the other half of the story is actually the velocity of money. And we've seen velocity of money rise dramatically. And that is the reason, by the way, why the inflation rate has not actually dropped, with the Federal Reserve, clamping down on the money supply. But in the last quarter and a half, or 2 quarters, the money supply, the velocity of money has dropped again very dramatically. And that drop is something that hasn't been factored in by the Federal Reserve in terms of what they're talking about in terms of the rate of change in terms of inflation. And what Cathie's saying, what I've been saying, is that drop in the velocity of money is going to be as important, if not more important, than the actual money supply. And I'm glad she finally talked about it this time, because I've been beating this drum every time we've met, and we haven't talked about it. I've actually shown the slide, despite the fact that she hasn't featured the slide before. But we are seeing the velocity of money supply dropping again back to the levels that we've been at since 2008 and 2010. And that, together with the reduction in the money supply, the drop in the velocity of money, will lead to a very serious problem, in my judgment, in the sense that we're going to see prices drop very dramatically as a result of this drop in the velocity of money.
And she went on to explain, for those who don't understand the velocity of money, this is how fast money is changing hands. And so to the extent that businesses are buying and selling more, to the extent that businesses are borrowing, are paying back more, to the extent that consumers are buying more and or borrowing more and or paying back more. The more that that money is changing hands, that is evidence of economic activity. When consumers and businesses stop changing or moving the money around as much, that's evidence that they've pulled back, that they're risk averse, or that they are they feel like they've got everything that they need right now, and they can't afford to take more risk on spending money on their backyard or on a trip. So what we're seeing now, and Larry and I are going to talk about this a lot more at the end of the show, is that the lower end of the business, of the consumer world, and small businesses are the ones that are cutting back on these expenditures. The money is moving slower, and all of the major companies you're starting to see this in their earnings report. Cathie pointed out, in particular, at the low end of the economic spectrum. Yeah.
Yeah, one way to think about it is that if I put my prices on my good up very significantly, double the price, it doesn't matter if nobody buys the damn thing.
Right.
So I can double my price. It sits on the shelf. Nothing happened, and so it wouldn't reflect as inflation, and so that's what we're seeing. We're seeing that the velocity of money spiked, and that's the reason why, even though the money supply has gone down, the actual inflation rate has remained fairly high. Now we're seeing the velocity drop. When that velocity drops within 6 to 8 months to 12 months, in that time scale, we'll see inflation rate drop significantly. If that velocity of money supply keeps dropping,
yes,
it's an indication of a very serious problem.
That is what I was going to point out, is even if you look at the chart, what we're seeing now is a couple of 3-4 quarters of evidence. It would take another bit of evidence before we could officially say that it's strong evidence. Right now it's evidence, but not strong evidence. Yeah, I think we 100% agree on that. Well, she went on from there to talk about the yield curve, which she had not talked about the last couple of months. I bring it up every morning and every night on my show because I just think it's fascinating that we're going to be going into the 24th month. It started July of 2022. We're now going to be at July 2024, and it has been getting worse the last couple of weeks. After it had gotten better, it's now getting worse again, or more inverted. Thoughts?
Well, I always point out in this conversation that it's only when the inversion, when we revert back to the longer term loans becoming more expensive, and we see the classic relationship between long-term debt and short-term debt. It's only when you get that reversion back to the norm that you get this this standard kind of situation of your and that's what we're facing. We're facing a point at which the reversion's going to happen.
Right.
And that reversion may happen in this coming month. It may happen in the 6 month, in a 6 month window or a 12-month window. But when it does happen, we are going to see a recession. We are. I mean, it's a given. Every time we do that reversion occurs, we have a recession. It's almost without fail.
Yeah, and so, this is so much longer. That last really long one was from like 1991 to just before the 2000 or just after the 2000 burst. So this one's so much longer than any one that we've really.
Well, the classic one, no, the classic was in 1980 because because the I mean, if you look at 1980, there was a burst there that occurred, but in general, you had this inversion running from 1977 or so, functionally until about 81, 82. So that was a fairly serious recession.
Got it. Got it. All right. So then she goes on from there to talk about, oh no, so I added here, this is the Bloomberg Commodity Index, Larry.
Yeah.
And we've seen where it peaked in, during COVID, obviously. Then it came slowly down back to kind of normal levels. Then just in the recent, since the beginning of this year, it has been going steadily back up again, and then just now has started to dip once again. But interestingly, the overall commodities are going down, but the precious metals and copper had been going like this. So we have, yeah, go
But
ahead.
copper's reversed its rise now.
Yes, just a little bit. Yep. I think I have it here. We have all commodities. Whoops, that's the wrong one. That is not it.
Wrong one.
Let's see here. This is gold. We know that gold had gone up like crazy, like some 25%, from 1,700, 1,800, all the way up to 2,400, now backing off to 2,311, but right in that range. We had, this is copper. Copper has dropped off. It was up at 525. It's back down to 447, but it's gone up from 365. And these still represent, huge highs in terms of the overall business, but dropping radically, as you point out, over the last month.
And oil is really beginning to reverse its rise quite significantly.
Right.
I think oil is going to come down dramatically in the next couple of months.
Yeah, and then natural gas has been the other one that, whoops, we'll go back to that in a minute. I thought I had natural gas here as well. No, I guess I didn't get natural gas. So, but anyway, all of this, we have a lot of evidence. Well, the evidence is crisscrossing. So we have precious metals going crazy up in general until Friday. We've got copper now coming off of highs, natural gas continuing up, which seems to have something to do with some specific decisions on the part of manufacturers or those who produce the natural gas to cut back on production. But all of these crisscrossing things you've talked about, Larry, for months about the recession that's moving, and Cathie talks about the recession that has moved from area to another area of the economy. Yeah, so, and last week couldn't have been any more confusing. And I think the market realized that. The market was saying, all the pundits were saying, the market indicators are all going in different directions. How can you get a handle on this?
Yeah, when you're in a state of flux with the economy, it's really hard to parse out these little pieces. I think that the overarching story is that you have very high levels of economic activity in specific areas of the economy. In particular, we've talked about the bubble in AI. We've talked about, we haven't talked about, but the Magnificent Six are doing extremely well. But everybody else is struggling or not doing extremely well. So I think earnings generally disappointed in a large segment of the economy, but did extremely well for those Magnificent Six.
Yes.
So I think that if you look at the economy as a whole, we're teetering on a very narrow brink. I am very, skeptical of the economy. I'm very skeptical of the prices of the so-called inflation, I think we're going to see a very significant bump. But I've been saying it for some time. And so, you know, if I keep saying it, maybe for another 10 years, I'll be right.
Yes.
But I really think that we're at the brink of a very tough situation.
Well, let's also talk about employment, because that's what Cathie calls it. She calls it Employment Friday. And so we have the employment numbers. We had the headline number come in extremely strong, Larry, way more so than anybody was expecting. But I'm sure you did like I did, and I looked at 𝐂𝐦𝐝𝐲, I looked at some of the other guys who dig deeper, AJ, and then I did a little digging myself. And when I got through digging, I didn't think the numbers were all that great. So we had
and they haven't been revised yet, because they're going to be revised down. You know that.
So we had continuation of full-time jobs actually dropping. We had a continuation of part-time jobs increasing to the point where more people, maybe ever than in history, have 2 jobs now.
Yeah.
I don't know if you saw that one. I didn't grab that chart, but there was a chart that was showing that maybe historically the most people that are now holding down 2 part-time jobs. So the job increases on that survey are likely maybe just due to the fact that not that more people have jobs, more people have 2 jobs, Larry.
It's
Are
not
they
impossible. That would explain a lot.
And then the household survey came in and had the greatest, continuing to have this huge divergence between what the household survey shows and what the job survey shows. So most people know that one of those is they call corporations, or they get corporate information and they look at it from the corporate side as to hiring and firing, et cetera. And then the other one is they call households. But never in history has the divergence been greater between those 2 reports, showing 4% unemployment on the one and continuing growth in employment on the other.
Yeah.
Yep. So one of the things that you have pointed to over and over again, so I went and grabbed this particular chart, is temporary help services. What is happening with temporary help? And I have a feeling that I have, Larry, did a little bit of a disservice here to you and me and everybody else. There we go. I was missing part of it. I thought that was true. So we saw during the pandemic, everybody is aware of this, that temporary help services went off the charts because nobody could find anybody to work for them. And that has been coming down, 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 down. Well, Larry, you know that you and I have had this difference of opinion here, where I've said the reason that was coming down was because companies had all the employees they needed. And so therefore there was no need to go get temporary help. Well, but that would bring us back then only to normal. And as this chart shows, we have now dipped below normal. So we're below pre-pandemic levels by a lot in terms of temporary help. Thoughts?
It's a continuation of the story. I think this is going to see continuing drop. And it may actually be a very big drop. I think we may see something like that 2000 drop, or even the 2008 drop, coming in the next couple of months. And, a lot depends. I mean, a lot depends on how the summer ends.
Yeah.
And so the summer could be a very big dip. And if that happens, it's not good. It's just not good. I continue to be pessimistic. I continue to be pessimistic across, the board. I think that the selective recession, or this, this rolling, what Cathie calls the rolling recession, may become a general recession.
Well, one of the other ways that she points to is this metals to gold ratio.
Yeah.
I want to come back to the help, or what I call employment in a second, but I did want to get this one up there because this one continues to split apart, continues to go in the wrong direction. Now, some of that may be due to the fact of things that are happening in currencies in terms of worldwide decisions by central banks to buy lots and lots of gold, in particular China, and also by the fact that Chinese consumers, South Korean consumers, and US consumers are buying lots and lots of gold. And so this may be throwing off kind of the historic numbers a bit, but I don't think it would be throwing them off this much. And so this looks like a chart ripe for correction. And the way that that correction would happen, of course, is a recession.
Yeah, I don't know that this is determinative because, as you've said, we have the Chinese situation where they're trying to disengage from the dollar. We have the Russian situation where the Russians are trying to disengage from the dollar. And so for that reason, we may be seeing a significant change in the metals to gold ratio. The metals to gold ratio, it gets established for a period of time. And if you look at this chart, it runs from like approximately 2004 to 2020, 2021, 22. And then it diverges. And so even, back in 1998, we saw divergence. So I'm not sure that this chart is determinative. I'm not sure this divergence is determinative. It could well be, the global political situation. And so time will tell. Time will definitely tell. But when you get this kind of divergence, it means that there are issues in the global, economy or the global structure. And the war in Ukraine is reaching a very critical moment, a very critical point. We don't know what's going to happen globally, but it's very critical. And the situation in China, Taiwan, also very critical. So is the dollar is the dollar standard under threat? I don't think so. Not in, the first world. In the second and third world, there are really, for the first time in a long time, there's ructions, and we'll see what happens. So I don't know if this chart is determinative or as determinative as Cathie thinks, but it definitely points to change, and that change may be political as well as economic.
All right. So one of the other things that showed up on the employment numbers, which was really dramatic, was that all of the gains, well, almost all of the gains, but virtually all the gains were in government, medical, and leisure. You got a small gains in some other categories, but all the real gains were in those three. Well, the government and medical, you might as well count those two together because almost all the medical spending is done by governments or insurance companies. So you've got, but that's also not sustainable. It's not likely to continue. Government spending for sure in the third and fourth quarter is not going to be going up like it did last third and fourth quarter of last year. Medical, it's
when you say medical, you're saying healthcare, really.
Healthcare, right? And then you got this leisure category, and the leisure world is going crazy. Their sales are fantastic right now.
Yeah, and that's a temporary situation. I think that's an adjustment from the pandemic, right?
Many people are saying that it's a continuing situation where folks that had pent up demand for travel are now getting that travel going and are able to get that travel. I think there's another piece of it, and that's what I want to talk about next. So let's take a look at this headline. This is from the Wall Street Journal yesterday. We both saw this article and both were unsurprised by it. So the economic data paints a picture of two Americas. The rich are feeling confident, but lower income households are growing cautious. Larry, you and I started talking about this, and I'm going to claim, I don't know if somebody can find something earlier, but I think our first conversation on this subject was probably about 6 weeks ago. And we talked about having no longer like 4 Americas. Some people would think in terms of the ultra rich, the top 10% or something, and then the upper middle class, and then the lower middle class, and then the poor. But really, I think America is getting much more divided into just those who've got ownership. They own their house. 40% of Americans own their house outright. 40%, no mortgage, own their house. And then you've got another 23% that own their house, and most of those have a 3% mortgage. So those people are probably feeling really, really good. And the folks that tend to own their house also tend to have some investment in the market. It might be their pension fund, or it might be that they're playing it themselves, but they got some ownership. Okay. And then you've got the rest of the economy, and they don't have ownership. The ones that have some ownership, I'm going to claim, are the ones that are taking the trips on the cruises. They can afford these trips. They're feeling really good right now. All of their assets have gone up. The amount of interest they're earning has gone up. Their stocks have gone up. Their portfolio has gone up on their pension. Their house has gone up in value. They're feeling really good. They're feeling really comfortable. And so they're able to make these trips. They're able to spend money enjoying themselves and having luxury. The folks who don't own, they're getting crushed by inflation, Larry. Just crushed. I want to show you this. I think it's this chart. No, that's not the one. Darn it, I thought I had these in the right order. Here's the one right here. This is showing the actual non-farm business sector, the real hourly compensation for all workers. And what you're showing here is up until 2021, even after 21, but barely into the 20s, you had a dramatic increase in the amount of real income among the folks. So really from 2014 on, but really started jumping up from 2016, 2017, 2018, 2019 really went crazy. And then now it's come way down again in terms of real income, dropping from 112.50 all the way back down to about 105. That's a 10%, 9% drop in real income among all income earners. But you know that that's going to be mostly the folks that are going to be hit by that. Going to be the folks that I'm going to call it the bottom 50%.
I think your chart doesn't bear you out as strongly as you think. I think the chart just shows that the huge government transfers into private hands as a result of the COVID pandemic spiked, but that we've reverted back to trend. If you look at 2024 on this chart, and you look at the trend established from 2013 through to 2020, I think you'll see that the trend is just reverted to trend. What you see in 2020, 2021, and 2022 is really government transfers, huge, gigantic government transfers. First, the Trump transfer during the pandemic, and then after the pandemic was over, Biden decided to transfer another $1.7 trillion. And so you had gigantic transfers that pumped huge amount of money into the non-farm business sector. And it went directly into people's pockets. And I think a lot of that money is being spent right now. And I think that's what's caused, people to believe that the economy's done very well and there's been huge growth. But it's just reverting where we are now, this precipitous drop from 2020 2021 to 2022 and then back down to 2023 is really reverting to trend.
Yeah, so all of that would be correct, Larry. Wouldn't disagree with you for a minute, except that this is real income. So this is taking out inflation. So
Yeah,
the inflation,
but it's still reverting to that non-inflationary
I agree.
trend.
I agree. But what I'm saying is the inflationary trend, the inflation hurts the poor, the inflation hurts the middle class way more than the upper class. So that's when people, you actually had a poll last week that said that that people actually voted in this poll that they would rather have a recession than continued inflation. So the constant drum of going out and trying to buy stuff that you have to have, the stuff that you have to survive, and it's higher than it was even 2 weeks ago, or it's so much higher than it was a month ago.
No, look, in that regard, you're absolutely right. Look, the all-in guys had the price of McDonald's price lists over the last I don't know, 5 or 6 years.
Right.
And the rise in the price of hamburgers and McDonald's food in general has been stunning.
Yes.
I mean, many times the rate of inflation went from a couple of dollars to like $6. I'm talking about, I don't know which particular package at McDonald's, but it went from like it went like triple or quadruple the price, and it was stunning. And so the people at the lower end of the income strata that actually do eat McDonald's because the food is so inexpensive, they are hurting the most out of this. So if you look at the income strata, you're quite correct that inflation is very definitely has struck very hard in the lower income, and that's always been true, by the way, of inflation.
Right, right.
So there's no doubt about it.
And the other thing on this chart you would see is that because we had zero inflation, okay, from 2016, from 2015, 2014, we had zero inflation all along this time, and paychecks were still getting higher. So this is, pre-pandemic, you had this trend with zero inflation and solid income, or
well, this is net. This is after. This is taking inflation out. But here's the point. There is no doubt that up until the pandemic, we were in a kind of Alice in Wonderland economy.
Yeah.
There's no doubt, 2000, and I would say from 2012, 2014, after the global financial crisis and after we recovered from the global financial crisis, during that period of zero interest, what's the acronym for the zero interest cost of money being zero, whatever it was.
Zero inflation,
zero.
Yeah.
We call it the zero interest rate, period. So during ZIRP, we were in a Goldilocks economy, but with the huge amounts of money that the government transferred to private hands in the pandemic, and the huge amount of money after the pandemic was over, that has created this gigantic inflation and has cost, us, a significant amount, has cost the lower income groups a significant amount of standard of living. But if you look across the board, after you take inflation out, we're just kind of returning to trend now.
Yes, I see that. Yes. So then if we look at this is household net worths. The household net worth from 1990 or before 1990, let's call it 1990 at 20,000.
Mm-hmm.
What am I looking at here? I'm sorry. I'm not, why am I having trouble? Oh, 20 million. Anyway, household net worths have been going up dramatically over this entire period, and are after the dip are now starting.
This is the total number of households at a net worth level.
That's right. Right. And then if you look at this chart, this is the average net worth now, Larry, for a household is at 1.1 million. And this is using the real mean and the nominal mean is at 1.1 million. And this is up from, in say, even if you take 2000, up from 400,000 on the nominal, 665,000 on the real, is now up to over 1 million for the average household net worth. Now, that's pretty remarkable. And I'm not saying it to just say that it's remarkable. I'm saying it because I think it's talking about what the New York Times is talking about. I mean, I'm sorry, Wall Street Journal was talking about, what you and I have been talking about for a while, is those households that are above that $1 million level, because this is the mean and the average. Those households that have $1 million and more net worth, are they're making the average household income now is around 110,000. People that are making more than 110,000 as a household and that have $1 million in net worth, those folks are not worried about whether they're going to go on vacation in December. They're going.
Yeah. And, this actually points to the real problem. I know that you're talking about class and the multiple different classes. And here you have, above the mean, people who have $1 million of net worth, that they have 100,000 plus of income after tax. And then you have, those folks, and a very large number of them, who are below the mean. And some of them are, really struggling. Inflation's killing them. We talked about the McDonald's hamburger going from $1 to $6. It's killing them. And it's very, very tough for them. And, this is what inflation does. And so we recovered from the late 70s, early 80s inflation. These people have found, a much better situation. They've climbed up the ladder. They're doing a lot better. And now, this burst of inflation, this huge kind of pump of money into the economy, has cost them all of the gains that they earned from ZIRP and before. And, now they have to climb this ladder again. Now, one thing you should understand, it's not always the same people.
Yeah.
People actually move up the ladder and move down the ladder. So, but it is a very tough, very, very tough situation.
And so this explains a little bit of the big question that's been being asked for the last 6 months. And this is kind of where I think you and I first came up with the idea of the two Americas, or the two economies, is
Right.
There's an undercurrent of dissatisfaction out there that's being
Huge.
measured in terms of the consumer confidence. It was measured in terms of credit card charges, hardly bumping up at all last month or the last 2 months. It's being measured in terms of people not going to McDonald's or Starbucks as often. And the pundits are sitting and looking at that, and they're saying, well, the economy's great. Look at all the stats. The economy's great. Why are these people so worried? Why are they so dissatisfied? No, it's two different economies, two different sets of folks looking at the same situation. And one of them is hurting and the other one's doing fine.
And Randy, it's very interesting that you bring up the two economies now, because the last time I heard complaints about the two economies, the last time the two economies broke the political barriers, was in the late 70s.
Yes.
I don't know if you recall it, but this conversation
I was 2
about
years,
the two Americas,
I was 2 years younger than you, Larry.
Okay. But it was a serious conversation then, and it's going to be a very serious conversation now, because inflation killed the people below that mean income group. In those days, I think we were talking in terms of $25,000 a year, as being, a very substantial income. And those people below that mean really, really got hurt very badly by that burst of inflation. It was much higher than it is now, and it peaked at a much higher level than it peaked now. But the same story, it killed those people. Now we have, a different situation. But we also have people with a very large amount of academic debt, this incredible amount of money, which I blame Obama for. Obama took over the student debt business
Yes, yes, yes.
and just blew the doors off on student debt. And now we're paying the piper. So we have, this really serious problem. This is what inflation does.
Yeah,
This is what inflation does.
yeah.
And, we're going to go through a very rough time, getting it back in shape again. And by the way, all those people with $1 million net worth because of, stock and so on, they could really be hurt very badly, if stocks adjust, if
Yeah,
interest rates.
so that was my other subject for today, Larry. My last subject, I have no slides for it. So I guess I can stop sharing. So the last subject for today is I have this new theory. We have 5 minutes. You have 5 minutes on the clock here, Larry. So we have 5 minutes to figure this out. I'm concerned, but not terribly concerned. I think that we're going to see an asset bubble burst probably within the next 12 months, maybe most likely, maybe even around the election or maybe just after the election. Probably doesn't even matter who wins. And the reason it's going to happen is only because it's gone too far. So you have the gold up here, you got silver up here, you got housing up here, you've got the stock markets, all three equity markets up here. Everything is so far out there that it has to come back. We always have to have that correction. My best guess would be we see a 10% correction, and I don't think anybody would even care. If their house went down 10%, if their stocks went down 10%, if their gold values, which went down 3.3% on Friday alone, it's not going to shake anybody's household situation up that much. But more typically, you have the bear market or 20% correction. Some people would probably be pretty hurt by that. Again, maybe a small percentage of the population, but even that would probably be something most people would go, oh, well, it'll reverse, it'll correct. But the big ones are always the 40%ers. And we've seen in California over and over again, 50 and 55% corrections in housing. That would hurt. A lot of people.
I wouldn't be surprised. Yeah, I wouldn't be surprised to see a major correction in the stock market. I wouldn't be surprised at all. I wouldn't be surprised to see, the stupendous six or whatever they're going to call it next, drop by 30, 40, maybe even 50%. Wouldn't shock me. I think the AI bubble will burst. It wouldn't shock me. I wouldn't be surprised to see property prices drop quite significantly. Property prices are supposed to drop when interest rates went up. They didn't. They actually went up. That doesn't make sense. When you have 1% interest rates, I can understand, very high inflated property prices. Now they're at 7%. Why are property prices not falling? So
lack of supply. The lack of supply has been the big issue. And you've had this continuing flood of immigration coming in. They have to live somewhere. And so everything happens at the margins. So if somebody comes in and gets your apartment because they're willing to pay $10 a month more, then that impacts the guy that's paying $700 a month, which impacts somebody that's paying $800 a month, which impacts somebody who's paying $2,000 a month, which impacts people deciding whether they're going to buy a house or rent. It's just like,
well, let's wrap it up. And by outbidding one another as to what we think is going to happen to the market, how much the drop is going to be. I mean, you're saying 10%, I'm saying 20. I don't know. But I think the risk is high that we are in an asset bubble, because I think we are due for a recession. I think that we have to revert to norm. And I think we are going to, and we'll see. And, they're now taking the possibility of a drop in interest rate, Federal Reserve drop in interest rate off the board for the year. They say it's not going to happen.
They finally agree with me.
I think that they may find themselves, the Federal Reserve may find itself having to drop interest rates very dramatically, because I think we could be entering in a significant recession shortly. That's my view.
Yeah, I think if that happens, Larry, I think it's November, because I think they'll be very cautious about doing it pre-election. That's just my theory. I think it's 0 for the year, but maybe.
Do you remember the election of 2000, my good friend?
I remember the election of 2000, but
John McCain, it wasn't 2000. What was 2008? John McCain, 2008. John McCain was calling Obama to say, let's stop the campaigns, and because we're in this crisis. And Obama's response was, we can walk and chew gum at the same time. We're going to go ahead with the election. But it was in the middle of the election. The Federal Reserve had to act, in the Federal Reserve pump money like crazy, not only into the economy, but bought assets, and raised a huge amount of debt, and gave General Motors and Chrysler a huge amount of money, and Ford a huge amount of money. So what I'm trying to say to you is that the election will take a backseat if we have a crisis.
If it's bad enough, yes.
And I'm not saying it's the crisis going to happen this year, but I think we're due.
Yeah. All right. Well, there you go. So I think we have your situation. You're saying possible recession later this year, possible cut by the Federal Reserve if there is a crisis. I think I'm saying almost exactly the same thing, only I'm putting the chances of a recession at 30% for the third and fourth quarter, and I'm putting the chances of the Federal Reserve cutting this year at almost 0, which I've been saying all year. Yeah.
You may be right.
Okay. All right. All right. So Larry, thank you so much for helping me figure out what Cathie Wood really said, and then also moving along a little deeper into some ideas that are the Larry and Randy show, you know, what we think is maybe going on in this crazy economy right now.
Thank you, Randy.
All right.
It's been
To all
fun.
of you, to all of you out there, it's been great talking to you.